Hey, everybody, and welcome back to the Teaching Tax Flow podcast. Today, episode 170. You might have heard a little bit last week. We were talking about really welcoming you into 2026. Today, we're going to dive a little bit more into some broader terms, if we will. I know we were a little bit more specific last week. We talked about those charitable donations that you definitely should listen to that if you haven't yet. This week, we're going to talk about some other changes that you're going to see as it relates to your tax life as a taxpayer. So, as always, Chris Picciurro, welcome back to co-hosting the podcast with me, sir. How you doing today?
Yeah, it's great to be back, and we are excited about this topic because we speak about the Teaching Tax Flow community all the time. We talk about our Defeating Taxes private Facebook group. We have well over 2,000 people in that group, very active, and we sent a poll out saying, what topics do you want us to cover on the podcast? And the number one vote was what's new in 2026. So we're going to tackle that right now. We had a huge tax bill, the One Big Beautiful Bill Act pass. I'm going to warn you that that sounds so negative. I'm going to happily let you know that a lot of these topics are already on our other podcasts or in our YouTube channel, Teaching Tax Flow. So this episode, we want to bring to your attention all the big time changes for 2026 that are going to affect the majority of taxpayers. And then if you have any questions or please comment on the YouTube video, and we're going to direct you to some deeper dive content. But you asked for it, and we're going to deliver to you what's new in 2026. And we had that little gift, One Big Beautiful Bill Act, dropped on us. I don't know if some people think it's a gift, some people don't, but it's a gift for content. Let's put it that way, right? Because we have a gift for tax planning.
And would it be safe to say, actually, Chris, that last year, calendar year, not tax year, right? Because technically, I think some people get confused with that. Maybe if we're talking about 2025, in 26, you're filing, quote unquote, filing your 25 taxes, but calendar year 2025, that may have been one of the biggest years for tax changes, maybe at least introducing them for future years too, right?
Sure. Yeah, I mean, in about a decade, the biggest. So when we talk about what's new in 2026, we're talking about what's new on your 2025 tax return that you're going to file in 2026. That's some of the stuff. So yeah, it does get confusing because sometimes people say, well, the 2026 filing year. Sure, but that's really your 2025 tax return. But yeah, let's talk about what's new in 26. Some of the stuff's going to apply to your 25 return. Some of it's going to apply to both years. So we're going to dive in. And the first thing is going to be that no tax on tips. So tipped workers can now take a new federal tax deduction for up to $25,000 starting for the tax year 2025. So that's new on your 2026 return. I want to preface this as again saying almost all of these deductions have phase outs, have limitations based on income. Many of them if you're married, you have to file jointly to take that deduction. So if you want a deeper dive or more information about any of the topics we're going to talk about, and John, honestly, I'm looking at all the things that off the top of my mind that are new. We have other content on it. So, but no tax on tips, big new a big new rule, and affects our I've got a daughter that gets tips, and it's going to affect her. So she's going to have a W-2. She's going to file a tax return this year. She's only 15, so it's going to be kind of fun.
It's going to be a proud moment for a dad. When the kids start filing tax returns.
Well, it's an opportunity to put money into the Roth IRA for them, and that's huge. No tax on overtime is the other one. So employees can deduct the premium portion of overtime compensation, $12,500 for single, $25,000 married joint for taxable years 2025 to 2028. And let's keep in mind, we talk on tax planning and on the tax planning implementations or tax strategies. Tax strategies or tax implementations, they don't like to be single. They like to mingle. They like to jingle. They like to be blended. They like to be stacked. So more than one of these deductions might apply to you. You could very well have someone that is works somewhere where they get overtime and their spouse gets tips, or you could work somewhere where you get tips and you work overtime. So it could, there could be multiple deductions for you. So no tax on overtime is new on the 2025 tax year. So it'll affect you in 2026. The higher standard or the increased standard deduction. So the standard deduction before the Tax Cuts and Jobs Act of 2017 was really low. OB3, or rather the Tax Cuts and Jobs Act increased it, and OB3 said, hey, it was going to go bye-bye. We're going to keep you. We like you. We're going to keep you on the Santa's good list. And now those standard deductions are indexed for inflation. And actually, they're indexed for inflation more aggressively at the lower tax brackets than the higher tax brackets. So higher standard deductions are here to stay. We have an expanded child tax credit. So if you have those children, and if you're in, and it gets actually a little more complicated, but you can get a higher tax credit for children, and that's going to affect your 2025 return. So you're going to see that on your 26 return. Remember, you're going to file a form 2441 to take advantage of that. I'm sorry, the 2441 is a child and dependent care credit, but you're going to have that. You don't have to file that form to get the child tax credit. Probably, oh gosh, it's hard to pick. It's like, when you say, hey, what's your favorite sports team? I've got 3 of them, 4 of them that I love. Or, if you have multiple kids, you love them all the same. So it's hard to say what my favorite new deduction is or which one's going to be most popular. But that higher SALT tax deduction, SALT tax cap, state and local income tax, that's a huge benefit to people in those high tax states. John, like you in Michigan, you got a nice state income tax, you have high property taxes. And like I tell my friends in Minnesota, someone's got to pay for that really good weather. So
Oh my God, that's a knife to the throat right there, man. And by the way, if anybody's not listening to this, 2 things really quick. So I know we're kind of powering through these. As Chris mentioned earlier, we've done almost an individual podcast pretty much on every one of these. So check those out. But then also why this is funny, and I say that about being stabbed by this man with the weather. He lives in Tennessee now. He's from Michigan. Don't let him kid you. He's from here, but he got smart and left. I moved away and I came back like an idiot. So we'll leave it at that.
you wanted to have that great weather and higher taxes. So you've got the higher SALT tax deduction. So now, if you itemize your deductions, you can, as a married couple, you can deduct up to $40,000 in state and local income tax instead of the $10,000 limit that was before then. Hey, new
that's
car loan
significant.
interest deduction. Go ahead. I'm sorry.
No, so that's very significant. That's a big
Oh,
jump.
yeah, absolutely. I think it's gonna increase the amount of people itemizing by 20 to 25 million people. That's what we're thinking. And remember, Joe, our most popular the most popular episode on YouTube for our podcast was we walked through the IRS data book. So we did look at a lot of those numbers as far as how many people itemizing, and et cetera, et cetera. So higher SALT limit is a big one. Hey, the mature age deduction. I call it this, they call it the senior deduction. So for those of you like me, I'd say that remember in 2025 was a big year for me. I hit 50. I got to now get to that Centrum Silver. Centrum, you should be a sponsor of this podcast, by the way. I'm calling you out right now. I'm not getting the senior deduction now, although my kids probably think I should. Maybe you should, John, because you're a little younger than me and you like to, of course, you hit the odometer too on a big number in 2025. So, but you're not necessarily getting that hitting 50 yet. But the new senior deduction, so taxpayers over 65 are eligible for up to a $6,000 above the line, or meaning a tax deduction. And both, if you file jointly, one spouse might be over 65, one spouse might be under, so you can get 6,000, 12,000. This was a compromise that brought both sides of the aisle together in Washington, because originally during the election, it was bantied about that there'd be no tax on Social Security. That's very difficult to do because it's a whole separate system. So we do have a senior deduction increase, and we've seen a lot of clients take advantage of that. John, we did some content, and I've been working with clients that are getting that senior deduction on over the next 4 years, where that deduction is alive at this point. If you have a married couple, both 65 and older, doing Roth conversions and basically getting up to almost $50,000 of income tax free by doing $12,000 Roth conversions over the next 4 years. So really look at that senior deduction. That could be helpful. There are phase outs. The QBI deduction, that was going to go away. That 20% deduction based on your net business income that comes on the personal return. And that is here to stay. So that was going to get expired as the Tax Cuts and Jobs Act got expired, and it was that they said, hey, you could stick around. So a lot of times we think about we don't even think about the higher standard deduction or the permanency of the QBI, but these are big time helpers for taxpayers, especially small business owners. So that qualified business income deductions, you might hear it called Section 199A, is here to stay. So that's a win for small business owners.
This episode is sponsored by Wealth Builders Mortgage Group, powered by Movement Mortgage, one of the top mortgage teams in the nation and a powerhouse in the real estate investing world. With over $1.1 billion in closed mortgage volume and more than 3,000 investor deals under their belt, they don't just talk the talk, they walk it. Their team specializes in helping short-term and long-term rental investors scale smart with customized lending strategies. They offer all STR loan products, including second home, investment, non-QM, bank statement, asset-based, and HELOCs. They also offer all primary home loan products too. Whether you're just starting out or expanding an existing portfolio, their unique Path of 10 strategy is designed to help you move from a 9-to-5 job to financial independence. If you're looking for a lending partner who truly understands the investor mindset, visit wealthbuildersmortgagegroup.com and start building your roadmap today.
Bonus depreciation continuation, that's at 100%. Remember, bonus depreciation under Tax Cuts and Jobs Act was 100%, and then it started trickling down, and it was going to be a 40% in 2025. Well, now it's, as long as your asset got placed into service after January 19th of 25, it's 100%. Again, doesn't mean you should always take bonus depreciation. Definitely check out our content to determine if bonus depreciation makes sense. Remember, Section 179 and bonus depreciation are different. They're cousins. I always talk about this when I teach my tax classes. They're cousins. They both provide you with first-year deductions, but bonus depreciation you automatically get, but you have to elect out of. Section 179, you have to elect into. So,
and I know with bonus, there was the phase out period. And now I know there was a big one in certain industries, right? Like people were saying, hey, if it goes away, what does that do for our industry as a whole, investors, certain types of things too. So
absolutely. So, yeah, especially in real estate, when we're talking bonus depreciation, is that engine that propels the cost segregation studies, which for real estate investors, especially in the short-term rental space, they love taking advantage of that bonus depreciation. So that's huge. And we've got some other things going on. The 529 plans are now, there's more leniency on what you can take out of 529 plans tax-free. So if you have a 529 plan and you have a child or grandchild or loved one, definitely talk to your financial advisor or tax professional, because you have now expanded tax-free distribution options from that 529 plan. So yeah, those are some of the bigger changes. We know the estate tax here for 2026, that estate tax exemption, we talked about that, went up to $15 million. So John, you can win another lottery and you're going to be just fine.
Yes. The problem is I have to play in order to win.
I know.
That's where the hurdle is, because I don't.
I don't play the lottery either. I know this sounds corny, but I feel like I already won the lottery, and I don't know that I just don't feel like I need to.
Yeah. I tell people when they talk about the lottery or gambling and casinos, sometimes they say, you know what? Try being a small business owner through college. That's gambling enough right there.
That is, yes, exactly.
So it's always good.
And then the individual tax rates I want to mention. Individual tax rates were about to what we call revert to pre-Tax Cuts and Jobs Act levels. Those are going to remain in place for 25 and remain in place for 2026. So those are big wins if you are in the camp of I want to have lower tax rates. So which are most people in our community, at least, considering our Facebook group is called Defeating Taxes. And I skipped one, John. I feel bad. The car loan interest deduction. I almost forgot about it. You up in Detroit are gonna. I think I got frazzled when you're talking about living in the Detroit area. If you purchase a new vehicle in 2025, you can deduct. Again, there are rules, but you can deduct up to $10,000 of interest on your vehicle loan.
That's awesome.
So
that's a big thing. I mean, and honestly, Chris, I don't know if this makes sense, but trying to think about it from a different point of view for taxpayers. Say somebody's listening to this, they're not too familiar with what we do here with teaching tax flow as a whole. Say they just chimed in here, they're listening to this and say, wow, I don't know what any of this stuff is. It almost looks like, I shouldn't say almost looks like, out of the things that we just really powered through, again, tons of content we have on really everything that we listed there. We've done something more deeper dive of. So we're looking from very high level. But sometimes the most impactful ones are the ones that remained in place that didn't even change, right? So things staying around and not going away may actually be more powerful than a big shiny, hey, look at this new deduction or change that we have here. So there's a lot that we ran through there. And I would say, um, and tell me if I'm wrong or not, but if somebody hasn't ever thought about taking advantage of anything tax planning related, this is like the golden age right now, I think, where you don't have to know all this stuff. You just have to find the people that do that you can work with.
Find the
Is the
right
big key,
people.
right?
And again, we're gonna have some live events coming up. This is interactive. You can comment on the YouTube video. You can go to defeatingtaxes.com, jump in. That group drove this entire episode. I'm going to leave you with two more things, and then we are going to say goodbye. Mileage rates have increased. So for 2026, the business standard mileage rate, 72.5 cents per mile, which is a very large standard mileage rate. And we have a new schedule. We have a whole podcast episode on that. We anticipate about 30 million people fill this schedule out. It is Schedule 1A, and that's the schedule that's going to reconcile all those new temporary deductions, no tax on tips, no tax on overtime, senior deduction, and automobile interest deduction. So I know we went through this quickly, but that's okay. We want people to have 1, 2 takeaways and say, that pertains to me. I'm going to dive into this. I'm going to ask the questions I need to ask. Let's work together to legally and ethically reduce the tax you pay in your lifetime.
Boom. And I like how you closed that on schedule. We're going to talk about schedule right now. We're going to let you go on this one, but we have some great topics coming up also in this podcast too. So a couple things for you. Again, don't feel like you have to know all of this stuff. Find the right people, maybe even just learn about some of this stuff through all of our content here and just the realization that these things exist. And again, find the person. It builds trust. You'll have a great relationship with that tax pro, financial advisors, etc. So as always, we'll wrap this one up. We'll see you next week here on the Teaching Tax Flow podcast. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.